So what we're going to be looking today. First topic is, of course, as always, it's a week ahead. So economic data, what we're going to be looking at the week ahead. So what we're going to be potentially be looking to trade, and why, the reasons behind it, and etc. Okay, so euro dollar, true to parity. Okay, so parity means 1.0. Will this happen? Will it won't happen? This is exactly what we're going to be looking today. And of course, answering everyone's question. If you do have questions, please send it over. It's not dumb to ask questions. Some people think that it's not good to ask questions, or he may think that I'm not smart or something like that. But actually, people that ask questions, they tend to be smarter than others. That's some common sense, because if you ask questions, then you can know what you've asked for, and that's a very good time for you to put your questions down for me, and I can definitely answer those questions for you. All right, all good, ready to go. Just delete. Right, heading to FinLogix. I'm going to go to economic calendar. And let's have a look on what it's waiting for us this week. So I just want the medium and high impact. And of course, I want all the countries. So I just select all and then click on this week. And let's see on Monday. Monday, we haven't had anything, but it's all over already. Tuesday, today, we're gonna have in a few minutes, 45 minutes, we're gonna have German consumer confidence. That's very important. Okay, this shows to us what actually the end consumer is thinking about the economy. If they tend to spend more money, then yes, the consumer is not liking the economy, but it's more easier for them to spend money, because they actually think that the money that they have, the $100 they have, is actually worth $100. So basically shows to us if the money that they're spending, they believe it's that money. Okay, it's that value, the monetary value. Later, we're gonna have UK confidence, consumer credit, sorry. And that should be pretty much it. We won't have much happening after, but the big boy is today at 6 p.m. And of course, it's Germany, so there is a big influence over the euro currency. Tomorrow, Wednesday, we're going to have the JOLTS. Well, that's going to be 1 a.m. today, so most likely I won't be awake. But JOLTS job openings for the month of September, most likely we will see less. Okay, and there is a very simple explanation of why. So if everyone remembers, we had the USA hurricane, okay, on a few months ago. So full of news here. You can just type USA hurricane, it will come. A lot of news. Hurricane risk may ramp up again for the US election. More storms brewing as historic hurricane season rolls on. So we are on a hurricane season on USA, especially for the month of September. Okay, so therefore, what I'm looking at is most likely we're going to have a decrease on job openings, because there was a lot of business that closed up due to the hurricane. Okay, so therefore, looking on a very simple perspective, most likely we're going to have less numbers than we actually are the consensus. Okay, the consensus is already below the previous, as we can see here, but we may expect even lower numbers. Then 11:30 a.m. tomorrow, we're going to have CPI from Australia. 2.3% is the expectation, coming down from 2.7%. So that's a 0.4% drop. really, really decent drop, okay? Prices is still very high in Australia. Things is still very expensive. House more rental property is still very expensive as well. So not that, you know, may sometimes be a little bit of a fake number in terms of that's not the number that the economy is feeling at the moment. Later on the day, we have Japan consumer confidence for October. We have France GDP, quarter over quarter and year over year, the preliminary one. Then we have Germany GDP growth rate quarter over quarter. That's very important. We have Italy. We have Euro area GDP growth rate quarter over quarter and year over year as well. And then to finish up the year, to finish up the Wednesday, we're going to have GDP growth rate quarter over quarter. So take on this way. Wednesday is pretty much a CPI and GDP and job reports day. Okay. And that's going to be really, really volatile for the market at the moment. All right. On Thursday, we're going to have inflation rate for Germany. Year over year and month over month. And the consensus is at 1.8% from the previous of 1.6%. Green just say, looks like we have mixed data for JOLTS and consumer confidence for US. How do we trade that? That's a good question. I'm going to address this question in a few minutes. Okay, so moving on, you know, expecting to have lower number on the Germany inflation rate. Most likely, sorry, a higher number on the German inflation rate. Most likely we will see this happening because if we look at the previous was 1.6%, the year over year one, and now are expected to be 1.8%. So, you know, a bit of a 0.2% jump, but still something that we definitely need to be looking at with attention. And most importantly as well, the month over month is from 0 to 0.2, so a 0.2% drop. That's pretty good for euro, okay? Most likely we'll fulfill a move up to euro dollar. Later on the day, we're going to get, on Thursday, we're going to get Japan, Bank of Japan interest rate decision, expected to maintain the same. And we can actually have a look on that in just a second. Let me just close this. Where is this? Not, yeah, perfect. And then later, France inflation. And most important as well, euro inflation rate, okay, year over year, expected to have a bit of an increase. If we do have the Germany and euro area inflation, both of them up, we may see a stronger euro, okay? Just in my opinion, I think euro is pretty oversold at this stage. So therefore, most likely we will continue to see euro, you know, pushing back up, but very slowly. And that should be it. We're going to have, of course, PCE, personal income expenditure, and that should be it for Thursday. On Friday, we have non-farm payroll, of course, unemployment rate, and average hourly earnings, okay? I'm thinking of being lower than 143,000. Okay, I'm thinking to be lower than 143,000, the NFP. The unemployment rate may increase to 4.2%, maybe, and the average hourly earnings at most likely at 0.3, a decline from 0.4 to 0.3%. Okay, that's my take, but we're going to be diving deeper on that in a few minutes. Okay, so first, let's go to chart. Guys, very easy here to use FinLogix, okay? It's you can just type finlogics.com and you will be on the website. It's free to use. You don't need to register or anything. As you can see, I'm not logged in or anything. I can just move freely on the website. Okay, perfect. So let's go for euro dollar first. And of course, we are talking about euro dollar here. So definitely something really interesting for us to talk. If you haven't watched my video yet, I've done a video today talking about euro dollar can come to parity, okay? And where is parity? Parity is at this moment, but let me just move back to everyone see it. So parity would be, let me zoom this out. Perfect. Parity would be somewhere around here. Okay. So yes, it is a big move. I know that. But most likely, if Trump wins, we will have euro dollar to parity. Okay. And I think it was 3 webinars ago, so not last week, 2 weeks ago, I've done a webinar talking about the reasons why if Trump wins, US dollar would be stronger. If we look to 2016, okay, we can come to ACY website and I can show you the picture. If we come to market analysis, and then we go to this one, and this is the image I want to show everyone. Perfect. So if we look to this picture, right, the market responses around 2016 Trump win, it was pretty interesting to note that some of the assets haven't moved a lot. Some of the assets have moved in one way and then it moved to another way later. So it's a 1 year before, 6 months before and 6 months after. So let's have a look at first on the picture A, that is the S&P 500 6 months before and after 2016 elections. We can see that, I know the picture is not that well, I've just took it from Google Photos actually, Google Images, sorry. I've typed it up, euro dollar chart for 6 months before and after 2016 elections. And we can see for the S&P 500, we haven't had much difference, okay? We had the trend S&P 500 and we had the 2016 S&P 500. And we can see that before, okay, 6 months before, we were trading pretty similar as we always been, okay? And then on the election day, we started to go up. So we pretty much get off from 100 all the way up to nearly 115, okay, for the 2016 S&P 500. So yes, that could be bullish for the S&P 500. Now, if we look to the Forex market before and after 2016 election, we have November 15 to November 16, and then November 16 to November 17. So this one is a year, okay, so a bit different from the picture A. So picture B shows us on blue USD euro, okay, it's the opposite of euro dollar. So US dollar on this case is on the base and euro is on the quote, as the orange line show us USD JPY. Everyone knows USD JPY. So we can see that the US dollar got strength towards some of instance, okay, and then later we had a weakening of the US dollar. So this is pretty notable on the USD JPY, where 1 year before we were having JPY, Japanese yen, being stronger than the US dollar, coming lower here. We can see that the euro has been weaker, okay? So it started all the way on 105 and ended on 100, okay? So soon as the election begins, all right, on November 16, We saw a huge increase, huge spike up on the USD JPY, meaning that the US dollar was stronger than the Japanese yen, okay? At some instance, as I say, at the first few months, few weeks, maybe 2 weeks or 3 weeks. And later, as we can see here on the US dollar against euro, we had the same effect. And then later, US dollar lose strength. Okay, so this shows to me that yes, the US dollar can strengthen, but maybe for 2 to 3 weeks only if Trump wins. Okay, now on picture C, we have the dollar and the trade weighted indices before and after 2016 election. So we have the US dollar against the the trade weighted indices and the dollar index. Pretty simple here on orange. We can see the dollar index has, decreased a lot. So all the way from 104 to 94. Okay, so that's 10 points. That's pretty much 10% here, and this is not good for the US dollar. So most likely, why I've called this euro dollar to parity is because I want to bring attention to euro is oversold and institutions are starting to buy euro. Okay, so no, euro dollar won't go to parity. Euro dollar may be bouncing back. Okay, and this may be the best time of the year, the best opportunity for us to get euro dollar back to 1.12. Okay, so yes, we've seen the month of September, the month of October having very, very bearish moves on euro. Most doing because the Trump win is sort of priced in already. I know, call me crazy, call me this, call me that, but look, if we get to, again, right, I'm going to do for the 150 million times already, come to poly markets and look at the how they're trading. Okay, the presidential election win in 2024, we have Donald Trump with 66.3% chance and Kamala Harris 33.8%. Now, if we look to USA elections pool, and we go to, let's say, 217 to win. It's a very nice website. I really like to use this one. I just want the map. Sorry, close this. Okay, perfect. So we can see that Trump has, a lot. And things are not looking that well as well, because I think at the first minute that we start to do the voting, all right, that they open the voting, most likely Trump will win. Okay, it will starting to win, but then Democrats will take more seats. What are specialists, what are some traders, what are some economic people saying is that we're going to be having a red swing. So the red swing is pretty much the Republicans getting on power. So that is Trump. Okay, but yeah, once we look to this, it's really big, right? It's really big, especially on Texas. Trump has 40 seats already. But don't forget from I forgot this one. Oh no, I forgot this one. Sorry, forgot the name of this one. But anyways, it's 54 for Kamala Harris. Okay. And the rest is just a smaller state. So I wouldn't count. And Florida has 30 as well. But like most likely we will see New York having Democrats, because New York has been, yes, some kind of socialism. And with the new era on the word, we can see that New York is pulling more towards Democrats than actually Republicans. Okay, so therefore, we're most likely to see Kamala Harris winning on New York as well. I may be wrong, but It is what it is. Now, interesting, very, very interesting. And the last picture I want to show is picture D. Is US bond markets before and after 2016 elections, all right? So 1 year before and 1 year after. The picture, explains itself. We've had a massive drop from 0.4% all the way to negative 0.4, so pretty much a 100% decline. And then afterwards, since the election begins, we can see a huge spike, all right, on US 10-year bonds. But some people may be thinking now, isn't the US 10-year bonds and US 2-year bonds and the DXY correlated? Well, let's have a look. So if I get the DXY, okay, let me delete all of it. And let me take off Eurodollar. And let me add US 10 years. And let me add US 2 years. Perfect. So let me change this to line. There we go. So in blue, we have DXY. In pink, we have 10 years. And in purple, we have 2 years. All right. Now, you tell me, isn't this correlated or is this negatively correlated? I mean, yes, of course, we do have sometimes that the price is, not always 100% perfect, but we are here to explore inefficiency on the price. We're here to capture, to be profitable on the times that the market is not linear, right? We need to have some sort of discrepancy in some way of the market to be able to trade it. So right here, we still have a positive retraction, and we can see that majority of the time, the 10 years and the 2 years, they've traded together, all right? If the 10 years is dropping and the 2 years is rising, most likely the 2 years will come back on the 10 years and they will continue to trade together. So every time that there is a discrepancy, they try to find each other. And this is exactly what is happening right here. So we have the 10 years all the way up here, and we have the 2 years all the way down here. We call these the spread, okay? So spread between swap change, okay? That's the name of it, swap between change. So once we have such a big gap like that, most likely we will continue to see stronger US dollar performing for maybe the next week or so. We're pretty much halfway through this week, and next week is already November. And from there, it's just, downhill. We won't be able even to think about what we're going to do, because we're going to blink and it's going to be already the 31st of December, and then 2025 is right across the corner. So yeah, all right. So basically, having all of these in hand, I want to show everyone. Let me just stop sharing my screen, because I had everything ready on the before my internet drops out. So let me just log into my Prime Market terminal. Oops, sorry. Okay, let me share my screen back again with everyone. Share screen. Perfect. You guys should be able to see my screen now. What I want to show is this off from here, is the actual commitments of traders, okay, from Euro. If we look to Euro leverage funds, okay, it's this one here. We can see this right there. Let me just, there we go. Perfect. So you guys can see it now. So Euro leverage funds on the 22nd of October 2024, we've had a change from positive to negative. But look at what it was happening since the 1st of October. If we look to the euro-dollar chart, let's come back to the 1 hour. Actually, let's go for 4 hour. It's a bit better. Oopsie. I don't like to zoom in and zoom out on this. It takes so long. Jesus. All right, perfect. So if we get on the 1st of October, right here, okay, we've just had decline. We haven't had any pullback this month, okay? This is not a pullback, okay? For me, this whole move down is actually a one-leg move, okay? And what I can possibly understand that there is two main options, okay? There is two main options from we breaking this bottom and actually coming back to this area, okay? On this box being my main target, right here. Let me just draw the box as well so everyone can see. Perfect. Or we can break through this top here, right there, and we can continue to trade higher. We can continue to go higher if we do something like this. Okay. Don't forget, we are on a nice support. Okay, it has been holding for quite a while. So this is the main reason why we bounce it back as well. But to actually have a understandable, let's say a real pullback, we would need to see a break above the 108,700. 108,700. Let's call it 108,700 so it facilitates everyone. So 108,700 is my main breaking area point. If we break through that, then yes, we will be able to trade long on euro-dollar. Otherwise, this is a no trade zone for me, okay, at the moment. Now, if we look at the commitments of trader, we can see that the leverage funds on euro has been going from 2.7 to 2 and now to negative 1.6. They've pretty much swapped from long to short. Okay, right here, 46 shorts. And now they have 39 longs, and they pretty much added 3 shorts. They've reduced it 4 longs and added 8 short positions. Okay, so really interesting what is happening on the euro. Now, if we go back and look at the US dollar continue to be short. So this is the big take now. If we have a continuation of leverage funds to short the market, but they were positive, okay? They were positive. We can have a look on here. They have been very, very bullish since September. Okay, no, sorry, July, since July. So they've had a change, and then they've been 4, 20, 28, 29, 45, 49, and then they've been, and then they've just changed it now. Okay, they've changed it on the 8th of this month, of October. Of course, we do need to understand that, yes, sometimes it takes times for the market to react, most likely 2 to 3 weeks. But hey, we may have a weaker US dollar, okay? Because this, it's not good, okay? Negative 32%. Okay, perfect. Now, next thing I want to show everyone is the, where is this? Seasonality futures, okay? If we look to the seasonality futures, we still have some sort of mixed approach. If we look to the US dollar, we can see that we will may likely continue to rise. And this is a very, very good tool, okay? We can see that from 29th of, well, pretty much, let's call it 1st of October, okay, just to facilitate. So from 1st of October all the way down to 18th of October, we would have some sort of decline. Let's just check it here. Let me put in candles. This is the US dollar. Just zoom in. October. Yeah, we haven't had that. Interesting. Anyways, it's showing some strength for us in the future, okay? Until 21st of next month, 21st of November. Now, if we look at euro, just around here, we completely see the opposite side, of course, right? So really, really not great how things are going to us on euro dollar. And now euro dollar here, we are on October. We're finishing October right here. And we're looking to have more and more downtrend. Okay, more and more downtrend. So yes, in some instance, we are having very mixed data. Now, coming to a fundamental perspective point, there are three main reasons, and I've mentioned it right on my blogs. Let me just get my blog here. Where is this now? Oh, sorry. I think it's on this one. Yeah, perfect. Nice. So there are a few key drivers of the bearish euro dollar. So first is the diverging central bank policies. Okay, pretty much we do have, where is my again? So we have two main big things happening from ECB and from FMC. So on the FMC side, we have a possibility of cutting 25 basis point. And the next most probable scenario would be 25 basis point cut for the European Central Bank. But we can see that there is a chance of the market pricing a 50 basis point cut from the ECB. Okay, so that shows to us that if that actually happens, we may have a very, very bearish euro, because the data coming from Europe has been pretty bearish. Okay, CPI has been much lower. PMIs haven't been that good. What else? We had GDP as well, not that well, not showing too much growth, and some other topics haven't been that great. Now, if we move on and look at the ECB on the FMC, FMC has been much more hawkish. Okay, it has been more approachable towards the monetary policy. They have been more like can I say that more sort of neutral to hawkish on the tone that they are taking, you know, and the data, and the most important thing that is actually being very, very hawkish for US dollar, very bullish for US dollar, is the data set that is coming from USA. It's very, very, very strong at the moment. We've seen US dollar, you know, every release that we have being stronger and stronger. GDP stronger. NFP last month was completely, you know, beginning of this month actually, so was very strong, and few other topics as well. But my opinion on the NFP for this week is that we may have some sort of relief from it, because we've had already, you know, pretty big disasters happening for the month of October and September. So most likely this will be affected now. The only problem is if the US dollar if the USA continue to print, if the US dollar continue to be printing better than expected data, we may continue to see a stronger US dollar. And if we see this happening, I do have a target, and my target for the, and my target for my next target, for the US dollar index would be at 105,500. Okay, right here. So 105,500 would be my next target. First target is where it is now. Second target, 105,500. Okay, 105,500 would be the second target. And if we continue to have some approach like that, we will continue to see euro dollar decline. And if euro dollar continues to decline, we may continue to see right here at 107 being the target. Okay. Perfect. So I've pretty much given my view. So right now is a no trade zone for me on euro dollar. Euro dollar, there's no risk to actually come to parity. I don't think it's a well thought approach. I think that if we wait until we broke through 108.7, okay, 700 right here. So yeah, we could continue to see euro dollar just ranging at the moment. All right, guys, we come to an end of another webinar. I think thanks everyone for being here. If you haven't yet subscribed to the channel, please subscribe to the YouTube channel. And don't forget, we do post daily content on YouTube. Okay, so I've just tried to be more straightforward today, not wasting too much time on the economic calendar or not murmuring around, just being straight to the point. And I think I could deliver the message. Thank you so much, everyone. I see you on Thursday. And from next week, we will continue to have Tuesdays and Thursdays, but we're going to be adding Wednesdays as well for the webinar. Okay, so be ready, because it will be really, really interesting, the topic of the webinar. It's more what is shaping the market than anything else that we've been looking at the moment. All right, guys, thank you so much. Have a great week ahead, and I'll catch up with everyone on Thursday. Cheers, guys. Bye-bye.